Good morning. Happy Friday. Give folks a few moments to join. Very excited you're here. Thank you so much for giving us an hour of your time on a Friday. There's over 1,800 therapists who RSVP'd for this webinar to learn about taxes, which is always really incredible for us and just super validating about the work that we do here at Herd. We have a ton to cover today, so I'm just going to roll right into it. We are going to be talking about how to optimize your taxes as a therapist. In other words, how to pay less in taxes. My name is Michael from Herd. Just a few housekeeping items. This is such a large group today that we disabled the chat just to reduce the amount of noise. There's over 200 folks here so far, and that number will continue to go up. With that said, you will see a Q&A button on your Zoom dashboard. Please leverage the Q&A, drop your questions there throughout. We will answer your questions in the Q&A, and then we'll select questions to answer as well. We'll also save time at the end. We really, really appreciate your questions. It makes this a lot more fun. So feel free, please, to use the Q&A. This question will get asked. So right up front, yes, this is being recorded. We will email the recording to you if you join late, or if you have to, drop off early, we will send it to you. We'll send you the slides as well, so don't feel like you need to take notes or take pictures of these slides during the presentation. We'll share those with you after the fact. Quick introductions here. My name is Michael. I host our podcast at Herd Business School. I've been working with therapists for over a decade, helping to support them as business owners and entrepreneurs. Melanie is here as well. She is our head of marketing at Herd. She'll be helping to manage the Q&A. And we're lucky to have Michael as well. Michael is a CPA on our tax team, and he's going to be helping to answer questions. So we have the dream team here today, and I'm just grateful they're here to support me in this webinar. If you've attended a webinar with Herd before, you've probably heard this. We love to set the stage with this idea that tax time is really all the time when you're a business owner. A lot of therapists think about tax time as April or maybe April 15th when they pay their taxes and file their taxes. But really, as a business owner, tax time is all the time. It's quarterly when you make your estimated quarterly payments. It's monthly when you decide how much to pay yourself and how much to set aside for taxes. It's even weekly and daily when you're making expenses in your business, which we're going to talk about today, how to track those and write them off. So really, we're thinking about tax time as something that's all the time throughout the year, not just once a year. Quick rundown of the agenda. We will talk about Herd and what we do really briefly. We're going to jump right in to tax deductions and tax credits. We're going to talk about investing in retirement plans and how that helps to reduce your tax liability. We'll talk about S corp, which is probably the most sexy topic in accounting. And we'll talk about some other tax optimization strategies as well. And we'll save time for questions. Again, folks who join late, this is being recorded. We'll send you the recording. Please ask questions, drop them in the Q&A. You'll notice the chat has been disabled, but Melanie is also going to be sharing resources in the chat as well throughout. So quick overview on Herd for folks who are unfamiliar. We are the accounting platform for therapist entrepreneurs. We empower therapists as business owners through software, as well as access to experts. On average, we find therapists save up to 60 hours a year using Herd, which at $150 an hour is an opportunity to generate an additional $9,000 a year in income, which is pretty amazing. We also provide peace of mind, and this is what we hear from our clients at Herd. We provide access to a help center that we're constantly updating with resources and articles. And we also have a really great support team at Herd. Michael is on our support team. And you can message us through your dashboard, and we do our best to get back to you within 1 to 2 business days that way. We're very excited about a brand new offering that we've never done before. I sent an email about it earlier this week, but to announce it officially here, for folks who join Herd during the month of October, we are offering a S Corp offering, and we're going to talk about S Corp and what that means. But as part of this offering, you get a S Corp readiness report. So we'll review your financials and let you know if S Corp makes sense for you next year. So this is for 2025. We will actually help you set up your S Corp. If you did this elsewhere, I've seen it cost as much as $1,500 just for the S Corp election and setup. There's no cost if you do it through Herd. It's just part of the benefit of being a Herd member. We're also putting together a Herd business course, which is the first time that we've done that as well. So super excited about that, all about S Corps. And of course, as a Herd member, you get access to year-round bookkeeping and tax support. If you're interested in learning more about this, I'm going to drop a QR code here. You can schedule a free consultation with our team. Absolutely no pressure to do so. But like I said, we do have 1,800 folks on this call, and we do have a limited number of consultations that we're able to offer. So I would definitely encourage you, pull out your phone, scan this code, and book one of those free calls. If you are a existing member of Herd and you're on the webinar, you get access to this S Corp offering. We're going to send you an email after this webinar with the link to join the waitlist for that. Leave this here for a second, and then looks like Melanie dropped that link in the chat as well. Great, so a quick warm-up poll here. How familiar, excuse me, are you with tax optimization? I'm going to put a poll up, leave it up for about 10 seconds or so here. Great, looks like, put 15 seconds on the clock. How about that? Great, get your answers in, Great. So looks like about 64% not very familiar. Makes total sense. That's why you're here. 34% somewhat familiar and 2% very familiar. So maybe there's some CPAs or accountants here on the call. Really glad you're here. Even if you are familiar, it's always great just to confirm what you already know or maybe get a refresher. So when we talk about tax optimization, a big topic is tax deductions and tax credits, right? These are things that you claim on your tax return that lower how much you pay in taxes. So at a very high level, a tax deduction is any business expense that's ordinary and necessary to operate your practice. Again, so any business expense, which we're going to cover what some common tax deductions are, not a personal expense. It has to be a business expense, and it needs to be ordinary. So it's something that is ordinary for therapists who are in private practice, and it needs to be necessary as well. And this is directly from IRS guidance. So just a few clarifications here as it relates to tax deductions. There are personal deductions that you write off and claim when you file your taxes at the end of the year. We're going to talk about some of those later on. In this section, we're really going to focus on business expenses. So these are those ordinary and necessary expenses that you have to operate as a therapist. Spending $1,000 on a business expense like a laptop does not mean you're saving $1,000 in taxes. This is a very common misconception. If I just have more expenses, instead of paying that money in taxes, I'm actually reinvesting it in my business. You can think about it as don't spend $1 to save 25 cents, right? So if you're taxed at 25% tax rate, that's how that works. We're going to show an example of that as well. And then just a really high kind of refresher overview. If you work as a W-2 employee, taxes are withheld from your paycheck, right? Automatically. But if you're working as an independent contractor with a group practice, or if you're working with Headway, Rula, Alma, an EAP company, you're being paid as a 1099 contractor. Taxes are not withheld. So you're going to owe taxes on that money, but you can claim tax deductions against that self-employment income. And then as a private practice owner, same thing applies. You are collecting money directly from clients, or maybe you're even taking insurance. You have to report that income to the IRS and pay taxes on it. And then a final point here on risk tolerance. There's a range of risk tolerance from aggressive to conservative when it comes to writing things off on your taxes. So it's really up to you and your tax professional that you work with to decide how comfortable you are and how aggressive you want to be. At Herd, we follow the guidance of the IRS. We want to protect our clients from getting audited. You can take more risky positions, but typically the riskier position that you take, the higher it is, the higher likelihood that it will trigger an audit with the IRS. I want to stop here to see first, Michael, if you have anything to add to what I've said, and then if not, maybe we can take a question from the audience.
Yeah, I'll jump in right here because I did see a question come through. The difference between the standard deduction, right, and itemizing business expenses, they're totally different, right? So personal taxes, everyone has a standard deduction or itemized deductions that they can take, right? That's one thing. On the other side of things, when you're a business, right, like looking at this laptop example, the business generates revenue, right, from therapy sessions that they provide to patients. And also they have office supplies, business equipment, et cetera, that they can take against that revenue. So whatever's left over is what gets taxed on you, right? Separate topic from standard and itemized deductions. So just wanted to clear up that difference also for the personal and the business expense question.
Awesome. And I can just jump in here with some good questions. So Michael, we got a question here. Are tax deductions the same if you're a sole proprietor versus an S corp?
Great question. I'm going to put a pin in that because we are talking about S corp later on. So we'll come back to that. But I don't know, Michael, if you want to say anything really briefly about that, or you want to just wait.
Yeah, I mean, the deduction wise, right there, yes, you're still a business at the end of the day, but your tax treatment, the way you got to report them, that all changes. But at the end of the day, yeah, so the laptop example, whether you're a sole prop or an S corp, you can still write that off, right? Again, there's different methods and different ways it's going to flow to you, which Michael covered when we go to S corps. But yes, essentially, regardless, you can write off those same expenses.
Right. And then just a quick clarification here as well. I see a question about LLCs. So if you just start seeing clients, whether you're contracting or you just launch a private practice and you don't form a business entity, you just start seeing clients and taking money, you're taxed as a sole proprietor by default. You are a sole proprietor. You don't have to form a sole proprietorship. It's just that's how you're taxed by the IRS. You can decide to form a business entity at the state level. Most states, you can form an LLC. That's what a lot of therapists do. Some states require a PLLC, which is a professional LLC, Texas, New York being the big ones. If you're in California, because California likes to be different, you have to form a professional corporation. But if you form an LLC, that's just a legal entity that you form with your state. You're still taxed as a sole proprietor. So the way that you're taxed doesn't change. Once you form a business entity, though, you can elect to be taxed as an S corporation, which we're going to talk about here in a bit. I hope that's helpful. All right, time for our next poll. As it relates to tax deductions, can you write off unpaid sessions? If a client doesn't pay you, if an insurance company doesn't pay you, if you offer a pro bono session, or maybe you offer a sliding scale session, can you write off that unpaid session? Get your answers in. All right. Great. Pretty even here between 50% no, 42% I'm not sure, and 7% yes. So unfortunately, the answer here is no. You can't write off an unpaid session. Why, going back to our definition, right, of a tax deduction is that it's a business expense. Unfortunately, you can't write off your time. There's no expense in this situation. You just didn't get paid. So there's nothing to write off. Now, with that said, you pay taxes on your taxable income, right? And so if you're not paid for a session, you have your taxable income is reduced, if that makes sense. So you earn less income. And so technically you're going to owe less in taxes, albeit indirectly, but you can't write this off. If you're a large corporation, you may have heard of this idea of bad debt. That is something that larger corporations can write off like over time, but for most therapy practices who operate on what's called the cash basis of accounting, it unfortunately is not something that we're able to write off. Great. So let's talk about some common tax deductions for therapists. We could do a whole webinar just on this, which we've done. We have a recording of it on our website if you're interested in that. Melanie will drop a link in the chat here as well with a link or a list of these deductions. A couple of things I just want to cover here. Business meals. So if you go out to eat with a colleague or maybe a potential business partner, you can write that off, but just remember business meals are 50% deductible, not 100%. Business travel is a really big one for therapists that you can take advantage of. So anytime that you're traveling for business, so think about flying to a conference, the flights, the hotels, write that off. That's a business expense. Definitely take advantage of that. Any CEUs, membership fees, software that you use for your business. A lot of therapists are using an EHR or HERD. Write it off. That's a business expense. Question we get, what about if I go shopping and I buy clothes? Not really a business expense, more of a personal expense. When it comes to clothing, the IRS defines it as a work uniform. So as much as we'd like to make the argument that cardigans are the official work uniform for therapists, unfortunately, the IRS would probably not agree. Vehicle use for business is one we get asked about a lot as well. One thing to note here is that commuting is not considered vehicle use for business. So if you drive to your office, you can't write that off. You can't claim off the business mileage there. However, if you're driving, say, to a client site, that would qualify. Credit card processing fees. So if you're using an EHR to charge clients your cash pay rate or using Stripe, those payment processes are charging you a fee. I think it's like 3 or 4% typically. At the end of the year, you can claim those processing fees as an expense, right? Because you're being charged those fees. And then this is one that is somewhat controversial. If you ask different CPAs, they'd have different perspectives on this one. But our position at HERD and one that we take with our clients, if they're comfortable, of course, going back to risk tolerance, is that personal psychotherapy is an ordinary and necessary expense for therapists to operate as professionals. Anything to add here, Michael, before we take some questions? Okay.
I think we have a few good questions here just on startup cost.
Oh, sure.
So it'd be helpful just to kind of reiterate what's defined as a startup cost and just understanding, like kind of what falls into it being something you can deduct.
Yeah, so a startup cost is what it sounds like. Any expense that you have for starting your business. I believe the limit for startup costs, you can write up to $5,000 in startup costs. And these are things like if you register your LLC, or if you pay an attorney or an accountant to get your business set up, if you pay to get a website, all of those things starting your business, you can write those off. Nice thing about startup costs as well is that's something you can roll over. So if you're like just starting your private practice later in the year, you can roll those over into the next year. And so, yeah, pretty straightforward there, just in terms of any cost to start your business. Question on percentage of travel, CEU. So most of these business expenses are 100% tax deductible. They're just a business expense, right? So it lowers the profit for your business, which is what you end up paying taxes on. Business meals is a little bit unique in that it's only 50% deductible. All right, any other questions here? Great. And then something here too, just to say is, if you operate a group practice and you're buying, snacks, putting them in the fridge, putting them out, those are business expenses. But if you're buying food for yourself, personal expense. So again, the question is always, is that business? Is that personal? Great. So there's also tax credits as well. So as I mentioned earlier, if you joined late, really a business expense is an expense that you have during the year. You're charging it to your business and it's lowering your profit or your net income for your business. You also are able to claim tax credits as well, and you claim those on your tax return when you file. So two of the most common credits that we see with our clients at Herd are the lifetime learning credit and the child and dependent care credit. I'd love Michael to just speak to these at a very high level if he is still here. I know he's in Florida and has had some Wi-Fi challenges. Are you still here with us, Michael?
I'm here.
Oh, great. Awesome.
Yeah, so credits a little bit different than deductions, right? As Michael explained, deductions are not dollar for dollar. So going back to that laptop example, say if it's 10,000 or 1,000, 20%, your effective tax rate is what you get a write-off from, right? That's what the amount that lowers your tax bill. A credit is actual dollar for dollar reduction. So say if you have the lifetime opportunity credit comes out to $500 and your tax bill would have been $500, well, there's no tax to pay, right? Because that one is a dollar for dollar. Now, with that said, there's actual income thresholds when it comes to credits, right? Since the IRS does give you money dollar for dollar, they do have phase out limits. So each of these credits are phased out at different points. So for example, lifetime opportunity credit, if you're single, I believe it's around $80,000 or less. And if you're married, it's 160 or less. So do keep those in mind. Everybody's situation is going to be different. So check with your tax accountant and they'd be able to walk you through the different credits and different limits for that.
Great. Thank you, Michael. See a question here. This one's timely about the upcoming election. I actually saw a post about this on LinkedIn today. Kamala Harris is promising a higher allowance for startup costs. I saw part of what she's proposing is increasing that startup cost limit from $5,000 to $50,000. And so just a point of clarification there, it's not a $50,000 like grant that you would receive. It's just that you can deduct up to $50,000 in startup costs. So it just increases the limit, but you still have to make those expenses, right?
And if I could just add on to that also, because my Wi-Fi did cut out when you're talking about the startups before. So currently it is 5,000 that you can write off immediately. But say if you spend 10,000, you don't lose that remaining 5, right? The difference, you just have to take it over. I believe it's over 5, 15, 10 years. They always change the amount. I think it's actually 15 years. So you would still get that deduction. It just takes a lot longer to recognize it. And the plan that Kamala Harris is proposing is just you would get that 50 or that 10 a little bit faster, right? But you still got to spend the money. So you're still coming out of pocket. It's just going to be now a timing difference and then how quick you're going to actually utilize that expense. So just to speak on that difference.
Great. Thanks, Michael. And then we got a couple questions about personal psychotherapy as a write-off as well. We have a great article that Mel can drop in the chat for us on personal psychotherapy. Caveat, in order to write off personal psychotherapy as a business expense, it would need to be a cash pay rate. So you can't like use your insurance or you can't write off a copay. You'd have to pay it cash pay as an expense in order to be able to write it off. Then quickly, Angela, yes, Psychology Today would be deductible. Great example of business expense. All right, time for our next poll. Are you currently saving for retirement? Put 15 seconds up on the poll. Get your answers in. All right. Give you one more moment. Awesome. All right. Pretty even here. So 51% said yes, 49% said no. I will say this is very common. I will say, especially if you're new to private practice, you're just trying to get clients, you're trying to pay your expenses, you're trying to build your business. Saving for retirement probably isn't the highest priority or top of mind. With that said, saving for retirement is a great way to lower your tax liability. And we're going to explain here how that works. I want to present a reframe of thinking about retirement. And this was something that was explained to me by a CFP, which is a certified financial planner. Quick caveat at Herd, we specialize in bookkeeping and taxes for therapists. We are not financial planners. Michael is a CPA, not a CFP. So it's a totally different license. What we can do is we can speak to the tax benefits of saving or investing in retirement. But I want you to think of saving for retirement as really investing in your retirement. If you're saving, you might as well put money under your mattress, right? And it's just going to sit there. But when you're contributing to a 401k or a SEP IRA, you're investing that money, and hopefully it's going to grow over time with interest, right? So we're investing in retirement. We're not just saving for retirement. Again, we could spend an entire webinar here on retirement planning. We don't have time for that today. What I do want to talk about are 3 different retirement plan options. And these are tax deferred on the way in. So how that works is if you contribute to a retirement plan, it lowers your taxable income, which is what you pay taxes on. So you don't pay taxes on the way in, and then you'd pay taxes on the way out. This is different. These 3 options are different than what's called a Roth IRA or Roth 401k, which is you're going to pay tax on the way in, and then it's tax-free on the way out. Why would you do it this way? The only reason you'd want to pay taxes now is if you thought you'd be making more when you retire and you're in a higher tax bracket, so you'd pay more in taxes. But this way, the idea is you're probably making more money now than you are when you're going to retire. So there's tax savings there. You're going to pay less in taxes on those contributions, but also you're deferring or you're lowering your taxable income. So SEP IRA, you can contribute, and there's also maximum contributions limits to each of these. So with a SEP IRA, you can contribute up to 25% of your earnings in a year, up to $69,000. Something with a SEP IRA to call out is if you're a group practice and you have employees and you're paying yourself a SEP IRA, you have to also match that percentage with your employees. You can invest in a simple IRA. Max contribution there is $16,000. If you're 50 or older, you can also contribute an additional $3,500 a year. These are called catch-up contributions. And then a solo 401k, if you've had a W-2 job, you're familiar probably with the idea of a 401k where you contribute and then your employer matches. Same thing here. You can contribute 25% up to $69,000. So if you're able to max these out, that's great, right? Because you're lowering your taxable income, you're investing in your future. Recognize that it's not always possible. Again, something just to clarify, I mentioned this earlier with business expenses, contributing $1,000 to a SEP IRA doesn't mean that you're going to pay $1,000 less in taxes, right? Essentially, if you at a 25% tax rate, using that example, if you contribute $100, you're essentially saving $25 on your taxes. So, Michael, anything to add in here as it relates to retirement?
Yeah, just keep in mind, solo 401k is specifically if it's just a husband, a spouse together in the business, if they're both owning it. Once you have employees, you can no longer have a solo 401k, hence the solo meaning. So if you do have employees in your practice, simple IRA or the SEP IRA are your best two options. The simple IRA is probably the more common one for group practices just because of the lower limits, right? And the SEP IRA, like Michael mentioned, you got to keep your contribution percentage the same. So the owner can't say, I'm going to do myself 25% and my employees, they're just going to get 5%, right? That's not allowed. You have to do equal participation regardless if those employees want to contribute to the plan or not.
Yep. Again, we are not financial planners, so this is something that would be a great conversation to have with a CFP, a certified financial planner. There's a great one that we've worked with. His name is Ryan DeRusso. He's written articles for our website. He's done a webinar. He's also been on our podcast, Heard Business School. Quick plug, maybe Melanie can share the link to that as well. I had Ryan on the show. We talked all about retirement planning. Again, we could spend an hour here, but just wanted to introduce at least these three as options for you, and just explain the tax benefits to lower your taxable income. All right, so we're going to move into S Corp now. So I'm going to throw a poll up. Are you currently taxed as an S corporation? Yes, no, and I'm not sure. It's okay to be honest. Great, going to give you a few more moments here. Awesome, love how engaged this audience is. Hit end. All right, so it looks like 82% no, 11% yes, and 8% not sure. So for the 8% that aren't sure, I would say you would probably know if you're taxed as an S corp because you've elected to be taxed as an S corp by the IRS. You would have, or your accountant would have submitted what's called Form 2553, which is the S corp election form, and then you would have received back what's called CP 261. I believe, Michael, correct me if I'm wrong. That's the form you get just confirming your S corp election status. For the 11%, oh, go ahead, Mike.
Yep, confirming that.
Cool.
And if you did lose that, you can always call the IRS and they can send you a verification letter to let you know what your current status is also.
And so for the 11% here, this one will be a bit of a refresher, but feel free to ask any questions that do come up. Great. So like what is an S corp? How does it work? We're going to talk about it because there's, I think, a lot of misinformation and confusion out there as it relates to S corp as a tax optimization or tax saving strategy. So first of all, I know it sounds like a type of corporation and a type of business, but S corp is actually a tax designation. So it's not a business entity. And so the way that it works, as I mentioned previously, is if you start your private practice, you start seeing clients, whether you're working as an independent contractor or you're seeing clients directly, you are taxed as a sole proprietor. If you decide, I want to form a business entity, I want to form an LLC, you do that at the state level. So if you're in Washington State, you form an LLC in Washington State, you're still taxed as a sole proprietor. But now that you have a business entity, you have the ability to be taxed as what's called an S corporation. Why would you do that? So when you are taxed as a sole proprietor, you pay federal income tax, state income tax if you have it in your state, and you pay 15.3% self-employment tax. And that covers Social Security and Medicare. So that 15.3% can be a big surprise for folks who are in self-employment for the first time. The way that S Corp works is you're taxed as both the owner and an employee of your business. So one way to think about it is you're essentially setting yourself up as a W-2 of your own business. So you set up payroll, you pay yourself a salary, you're going to pay payroll tax on that salary, which is equivalent to the self-employment tax that you would have paid as a sole proprietor. But everything that you take out of your business on top of your salary as what's called an owner's distribution is technically tax-free, and that you don't pay self-employment tax on that. So essentially, you're saving that 15.3% on owner's distributions. We're going to show you an example of what that looks like with some actual numbers. But again, the tax savings come in by reducing the amount that you pay in self-employment tax. This sounds great. Why wouldn't everyone do it? There's also expenses that come with being an S corporation. Our general guidance here is that you should probably be making at least $100,000 in net annual income for S corp savings to really make sense for you and your business. Big caveat that this also really depends on your tax situation, depends on where you live. But just in order to be really clear, typically what we recommend here is if you're starting to make 6 figures or more, and this is net income, so this is your profit or your income after all of your expenses. It's not after taxes, just after your expenses. So all those business expenses that we talked about. So if you're making more than 6 figures, probably makes sense to at least look at S corp. Something that we typically see is that when a therapist starts a private practice, they have expenses when they're getting going. You know, the first year, they're not making that much money, file their taxes as a sole proprietor. And then the next year, they're making a lot more money, and now they have to pay a lot more in taxes, right? And so this is when S corp, we start to have that conversation with clients. So at this point in the year, it's probably too late to elect to be taxed as an S corporation, something that you can look at for 2025. I don't know if we mentioned this here, but I'll say it now. There is an S corp election deadline. So March 15th is when you would need to elect to be taxed as an S corp for the current tax year. Or if you form a business entity during the year, I believe you have 2 months and 15 days, Michael, correct me if I'm wrong, in order to be taxed as an S corporation. Our general recommendation is if you're new to private practice, you don't know how much money you're going to make unless you know I'm just going to come right out of the gate and make $250,000 in my first year. And like, then that's great. Then we can have that conversation. But typically we recommend against S corp right away, just because you don't know how much your business is going to make. I want to show an example here because there's probably a lot of questions that we can answer with the visual, and then I'll go to the Q&A mail if that sounds good. So as I mentioned, when you're taxed as a sole proprietor, or even if you have an LLC, we're going to look here at this left column. At $100,000, you are charged 15.3% self-employment tax, right? So you're going to owe $15,300 in self-employment tax. All of the profit from your business is being passed to you because you're a sole proprietor, and you're paying income tax on $100,000, which is your net income. Now, if you elect to be taxed as an S corporation instead, and you pay yourself a salary of $50,000, again, caveat here, these numbers are for the purpose of this example, just to show you what it could look like. $50,000 in salary really depends on where you are. A reasonable salary for a therapist in New York City is going to be very different than a therapist in a more rural area. And so this is where you would work with a tax professional to determine what that reasonable salary could be. But for the purpose of this example, you pay yourself a salary of $50,000. You're paying, instead of self-employment tax, you're paying payroll tax on that $50,000 at a comparable 15%, which is $7,650. And then you're still paying federal income tax, right, and state income tax on the $100,000, but you're actually only paying payroll taxes on $50,000 or self-employment tax on $50,000 instead of $100,000. So in this example, you would save $7,000 $7,650 in taxes by electing S corp instead of sole proprietorship. And with that said, as I mentioned, well, why wouldn't everyone do that, right? Well, everyone should be an S corp. Well, there's also expenses, right? So if you don't have a business entity yet, you need to set that up. Depending on where you live, and if you work with a lawyer to set up your business, it can be $500 or more. As a business entity, you also are going to have annual filings. I know I set up a LLC in the state of Massachusetts, and it's $100 a year just to maintain my LLC. You can think about it as like a license for your business, similar to your license to practice. You're going to have to go through the S corp election process, which I mentioned earlier. If you pay an accounting firm to do this for you, I've seen it as high as $1,500. We'll do this at Herd for our members for free. There's no additional charge for this. As an S corp, you also are required to file a separate business tax return, which accountants, tax preparers will charge $1,000 or more. You're also going to pay, depending on where you live, an additional franchise tax. I know this is especially true in California. And then you have to set up payroll as well. And so a typical payroll software like Gusto, which we partner with at Herd, is about $40, $45 a month. So just from this example, it's about an additional $4,000 to $5,000 a year in expenses to be an S corp, and you're only saving $7,000 a year. So it really only nets out to about $2,000 a year, which for all of the hassle to do, it may not be worth it. So again, depends on your unique situation. And also as it relates to your salary, you would increase your savings by lowering your salary, right? Because like the less your salary, the less you pay in payroll taxes. But once you get below a certain level, that's when it gets riskier, right? And so again, we always try to follow the guidance of the IRS and protect our clients as much as we can when it comes to S corp. So the takeaway here, hopefully, is that S corp can be great. It's not great for everyone. There's additional expenses, so make sure that it makes sense for you, and definitely consult with a tax professional. Quick plug here for folks who joined late, and I'll mention this here again. We are offering an S corp readiness report and S corp election for 2025. If it makes sense for you, for all Herd members, you would just have to join Herd by the end of October. Michael, anything to add here as it relates to S corp?
No, you pretty much nailed it. Just everybody know that's a very straightforward example, right? With nice, clean numbers, not taking into consideration your distributions, which also play a role into it. So in Michael's example of taking those expenses, the $2,000 tax savings, why it might not be worth it? Because you can get into other issues. If you need more money on top of your salary, you could cause an inadvertent tax impact to yourself without getting too high level, which would wipe out those savings additionally. So it's always best, communicate directly and look at your situation specifically before just going on a limb and saying, hey, great, I reached this threshold, no other analysis needed. Let me go off and make it, right? So it is a powerful tool, but you need to set it up correctly, and you got to understand the entirety of the S corp process for it to make sense and benefit you.
Yeah, great point. I see a couple of questions here. So for the $100,000 threshold, that's in self-employment income. So if you have a W-2 job as well, your taxes are being withheld, right, from that W-2. And so when you think about the tax benefits of S corp, it's really on those self-employment taxes. So I would look at your self-employment income separately from your W-2 income for the purposes of this. Any other questions, Mel, that would be good to take here?
Yeah, I think a good question here is, what if you elect S corp, but then you don't end up making over $100,000?
So you won't go to jail. Oh, you want to take that, Michael?
No, I was going to say the same thing. You're not going to go to jail. It's just you're going to have all these extra costs and expenses and time, which you're not going to see any tax savings. So it's kind of just, I guess, opportunity costs you lost there. But I mean, there's nothing wrong with it. Just make sure you're still paying yourself a reasonable salary at that point. That's going to be the biggest risk with the S corps, right? The reasonable comp.
I will say that dissolving an S corp or switching from an S corp back to a sole proprietorship can be a pain. It can take time. And so you want to be really sure before you do the S corp that is what makes the most sense for your business, and that you make sure you do the due diligence and you talk to a professional. Because if you set up the S corp and then you decide later I want to switch back, it can be kind of a pain in the ass. All right. Awesome. We're making good time here. Looks like we have about 15 minutes left. For folks who joined late, just a reminder, this will be recorded, or it is being recorded, excuse me. And if you're watching the recording, hello, thank you for tuning in. If you have to jump off early, if you have a client, we'll send the recording to you. We disabled the chat just because it's such a large group, but the Q&A is open. So please, if you have questions, drop them in the Q&A, and Melanie has been managing the Q&A. Thank you so much to Melanie for doing that. Awesome. So we're going to just run through some other tax optimization strategies. These are common questions that we get on these webinars, and it's also some common optimization strategies that we leverage with our own clients at Herd. So a big one is charitable donation. So if I donate to a charity, can I write that off? Yes, that's one of those personal expenses that you can claim when you file your taxes. Just make sure that the organization that you're donating to is a 501c3. So it's a certified charitable organization. That's a great way to pay less in taxes instead of paying it to the IRS. You can support a cause that you care about. Hiring family members. Can I hire my kids? I've heard I can do that. Absolutely. Hiring your family members is just like any other hiring anyone else, right? So just think about it as I'm hiring a contractor, essentially. So it's a business expense. So you're lowering your taxes, right? By lowering your profit for your business by hiring someone in your family. But a way to think about that is, well, instead of just paying it in taxes, I'd rather pay it to a family member. And it's just, again, like it's a business expense, just like any other business expense. Health insurance premiums. I'm going to ask Michael to speak to this one because it's a little bit more nuanced.
Yeah, so health insurance premiums, again, different way of recording if you are a sole prop, a single member LLC, or an S corp, the reporting. At the end of the day, yes, it is a write-off for you that you can incorporate in your business. Just the mechanics of it, depending on how you file, is how you get the write-off. So I know that's a common question. For the S corp specifically, you have to be running payroll in order to utilize it because the health insurance premium is part of your salary. But as obviously your business pays for it, you get a deduction there, and then it flows down to your personal tax 1040. Again, I know a little bit nuanced, but just to describe the process, it gets above the line deduction as a health insurance premium write-off at that level. So short answer, yes, just a lot of steps and different how you treat them.
Great. Home office. So this is one that a lot of our clients claim. If you are working from home, seeing clients virtually, your home is your primary place of work, and you have a space in your home or your apartment that's used exclusively for business, you are able to claim the home office deduction. There's two ways that you can do it. There's the standard deduction where you get a certain dollar amount or the amount of square feet and you claim it that way. And then the other is you claim your actual expenses and your percentage of business use. And so the way that you think about that is you take your mortgage or your rent, you would measure the square footage of your home office. So for simplicity purposes, if your apartment is 1,000 square feet and your home office is 100 square feet, you'd be able to claim 10% of your mortgage or rent. If you own your home, you can still claim the percentage of business use for things like your utilities or your phone. So make sure that you are taking advantage of that, not leaving money on the table. This one is one of those ones it's technically a personal expense, right? Because your mortgage, your utilities, those are all personal expenses. But when you go to file your taxes at the end of the year, you're able to write off the percentage of business use for those expenses. If you have a office and then you work from home part of the time, probably doesn't qualify. Again, it needs to be your primary place of work. Student loans. This is one that we get asked about a lot. I'm sure a lot of folks on this call have student loans that they're paying off. No, you cannot write off your student loans. However, you can write off your interest that you pay on student loans. So the principal, which is the loan amount, you can't write off, but the interest that you pay, you can claim when you file your taxes up to $2,500 a year. With that said, there is some limitations, I believe, on your income. So if you're making over a certain amount, you may not qualify. So just want to check on that as it relates to your unique tax situation. And then this is another one. So you may have heard of an HSA. An HSA is a health savings account. So it's a form of a retirement plan. You can think about it that way, but it's used specifically for healthcare expenses. And the great thing about an HSA is you don't pay taxes on the way in, you don't pay taxes on your capital gains, and then you also don't pay taxes on money coming out. So it's called triple tax savings, I believe, Michael. A little bit lower threshold here in terms of how much you can contribute. That's about $4,000 for just yourself, and then about $8,000 for your family. So this is another one of those tax, saving opportunities. Max this out if you're able, and then you'll have that, money if you need it.
Yep, just one thing to add on the HSA, agreed it is a triple threat. You have to specifically have a high deductible insurance plan in order to qualify for it. So just make sure with your insurance provider, if it is a high deductible plan, then you qualify. If it is not, then unfortunately you can't contribute to it.
Yeah, it's a great point. Anything here, Mel? I know we're going fast.
Yeah, I think there's a lot of really good questions just on home office deduction. So I think just confirming when it applies, folks are asking if they go into a physical office and also work at home, just really clarifying kind of what to think about there.
Could you speak to that, Michael? My understanding is that it needs to be your primary place of work in order to qualify. But is that what you've seen?
Yeah, so it does have to be a primary, and you do routine work there, right? It's not just, hey, maybe like 2 times a month I do admin checks from my home office. No, it has to be exclusive and regular use of it. And then obviously the exclusive has to be, say, the easiest one to prove, leave a separate bedroom, and that's only the activity that goes on there, right? The burden of proof is always on you to prove it to the IRS, so keep that in mind. They are flexible sometimes if there's like a unique space within the room. If you carve it out, they would allow that. But having the separate room is the easiest way to prove that you're doing that. And obviously for the tasks, just if you're keeping track of your time, just data, and with your minutes, just writing the information in there, how much time you actually did spend in your home office to prove it.
Great. And then there's a couple clarifying questions around the HSA, specifically high deductible. Like, how would you know if you have a high deductible plan? Would they tell you? Would that be part of the plan that you sign up for?
Yeah, the health insurance specifically tells you this is a high deductible plan. So you can't tell them, but you can't override them. It's pretty clear cut. That's the plan that they offer. It's a high deductible. And obviously the trade-off is your premiums are going to be, higher for that reason, just because your deductible costs are higher. But the offset is you can put that money towards the HSA plan so it grows. So if you do need the money for medical reasons down the line, they're tax-free. And actually one important cool aspect of it, HSA, is you got to keep receipts for those expenses, right? So if you pay out of pocket and you don't want to reimburse yourself from the HSA plan, that's totally cool. But keep those receipts, because say in 10 years, if you do need to end up taking out money from your HSA plan to reimburse yourself 10 years later, you can't do that, right? So keep those receipts, keep those files, because you don't have to necessarily just reimburse yourself the same year, right? You can be 5, 10, 15 years down the line. There's no expiration date of when you can actually reimburse yourself.
Great. We have about 4 minutes left here. So I just wanted to throw this up here again. If you're interested in electing S Corp and seeing if it's right for your business, we are offering a special S Corp offering. This is members only for Herd members. So if you're a Herd member, you can take advantage of this. It's included in your subscription. If you're not a member of Herd yet and you're interested in taking advantage of this, you would just need to join Herd by the end of the month because we're going to run this in November and December. If you scan this code here, you can schedule a free consultation call with our team. Again, no pressure, but always recommend scheduling a consultation call just to see if Herd makes sense for you and your business. And then before folks jump off, when the Zoom ends, there'll be a pop-up 3-question survey. If you could please submit that. That's really helpful for us so we can improve these presentations for you moving forward. We have a few minutes left here, so happy to take some questions. Question about hiring. Oh, you go ahead.
Sorry about that. Just referencing back to common deductions, one I saw a few times here. If you see a client and they don't end up paying you for that session, is that something you can write off?
Unfortunately not. So remember, unpaid sessions, not a business expense, right? So always think about like business expense we can write off, but if there's no expense, even if we don't get paid, then there's nothing to claim, right? To write off. So, unfortunately not. That's a great reason to have a cancellation fee or a no-show policy, right? So we're still, if a client no-shows or doesn't show up, we're still generating, income for that session. But no, unfortunately not. If we're partially paid or not paid for a session, we can't write that off. I was going to ask you, Michael, so question about hiring family members. So I mentioned one tax saving, strategy is to hire family members. It's technically just a business expense, right? Just like any other contractor. But say if you wanted to hire your spouse or your child, what's kind of the process of doing that from a tax perspective? Are they officially a 1099 contractor? Do you need to have specific forms to do that?
Yeah, so that's another one that's very nuanced, like you can tell in the tax code how it is. So you do not want to pay them as a 1099 contractor. Reason being, right? They are going to have to pay the self-employment piece to it on their tax return. Plus, for a 1099, once you're above $600, you do have to file a tax return. Versus if you pay them as a W-2 employee, right? Then they qualify for, hey, standard deduction, W-2, it's not self-employment. So for that piece, they wouldn't have to file for anything under that threshold, and this specifically for your child, right? Because if you're married with your spouse, you're going to be into the same tax return, so it doesn't do anything. You're just moving one pocket to the other. And then also coming into play, age-wise, right? If you're under 18, you don't have to pay the social security aspect to it as a W-2. Does not apply if you're a 1099. Again, so very nuanced. And then even a step further, where you're paying them from, right, as a family member, W-2 also impacts it. So IRS code says if you're an S Corp and you put them on W-2, they are not exempt from that, even if they're under 18. It would have to be from a sole prop, which you have payroll set up. Again, so this is all speaking up to very high level. To get a detailed, tailored response, you would need to work with someone directly that can guide you in your specific situation. So it is a good plan. All these strategies are always good to think of, right? But then it's more dive deep and see your specific situation, if it's even possible or if it makes sense. And always taking notes, right? Supporting documentation is always the key for all of this.
Great. We're at the top of the hour here. So I just want to say thank you so much for your time. I hope this was helpful. I know we covered a lot of really great information here. So we're going to send you the recording. We'll share out the slides as well. Just wanted to say thank you to Melanie and Michael for jumping on here with me today, and enjoy the rest of your Friday and have a great weekend.